Brazil's farm economy has faced immense pressure over the past couple of years amid high interest rates, rising credit defaults, and negative soybean break-evens. The country has seen a substantial increase in soybean acreage over nearly 2 decades, but could diminishing farm liquidity lead to a halt in acreage growth? Negative soybean production margins in Brazil persisted through much of the 2024-25 season and into the current season. A break-even calculator from Bloomberg Intelligence shows that margins have been consistently negative for the past 16 months. That has been driven by compressed soybean prices relative to elevated fertilizer, financing, and operating costs. Negative margins have put a large strain on Brazilian credit due to tightening liquidity. Additionally, rural credit defaults have been rising substantially over the past 2 years. Currency appreciation also is a contributing factor on margin pressure. The Brazilian real strengthened considerably against the U.S. dollar since the beginning of 2025. As dollar-denominated soybean sales are converted into local currency, producers receive fewer reais for that commodity. Banco do Brasil, a major lending institution, says the 2026 outlook has become more challenging than expected at the start of the year, particularly in the agribusiness sector. The company reported that it's facing its highest default level ever recorded in its agribusiness loan portfolio. The defaults do stem from soybean, corn, and cattle producers. We're already seeing tight margins translate into tighter spending. Farm equipment demand deteriorated in April, with large tractor and combine retail sales dropping 39% year over year. Additionally, higher interest rates and rising input costs could lead to a limited acreage expansion if farmers become more defensive with planting and input spending decisions. This past season, Brazilian farmers planted a record 120 million acres of soybeans, up nearly 3% from the previous season and the 19th consecutive year of growth, according to data from Brazil's National Supply Company, or CONAB. That has led to record growth in overall production, boosting output to 180 million metric tons for the current season. At the very least, acreage could plateau if market conditions lead to farm consolidation rather than a contraction in plantings. Record soybean output and China demand are helping counter margin pressure, yet elevated borrowing costs and fertilizer remain limiting factors. Brazil's soybean acreage expansion story is unlikely to end abruptly, but the era of near-automatic annual growth may become increasingly dependent on improved farm profitability and easier credit conditions. Thanks for watching. I'm Dawson Schmidt, and this has been a special report from Trader PhD.